Afternoon, everybody. Dustin Tenbrook here with the Presidio Perspective, episode number 10. I can't believe that. Episode number 10. 10 weeks, week in and week out, we've been here together. Where else would you want to be on a Wednesday when you don't have that many options? So glad that you spend your last hour of your Wednesdays with us here. I'm really excited for my guest today, Gene Goldman. Many of you got to see him at our client events in the past. So Gene Goldman is the Director of Research, Chief Investment Officer at Cetera. And we're just really pleased to have him join us today. So Gene and his team are a big part of the research that Presidio relies on for a lot of the decisions that go into our portfolio selection. So Gene's going to be talking today about his 3 predictions for 2020. Now, Gene will tell you. Let's actually make sure that we have Gene here today. Gene, are you there?
Yeah, I'm right here.
All right, good. So now we've taken your advice in the past, and so whenever we have you on, we know now it's always after hours or on a Saturday. Is that right?
Of course. I love it. Perfect timing.
Yeah, that's right. Because if you ever see Gene, he's frequently on CNBC and Fox Business, and, they're always calling him to ask him about his views of the markets. And whenever he gets on, it seems to be a red day. Is that right?
Of course, except for today. Thankfully, we had a good day in the market, thankfully.
Yeah, that's right. Okay, so when you come on to the Presidio Perspective, it's good for the market. So we'll just have to keep you coming back for the future.
Exactly. Sounds good.
Yeah, awesome. Well, I had a chance to talk to you a little bit before. I'm really looking forward to you sharing your views of what's going on here, and get your perspective and the perspective of your research team there on what's happening in this economic recovery, and trying to make sense of what's happening with the stock market and markets and what we might expect for the 2020. So without further ado, I'll let you take it from here, Gene.
Sounds good. Well, again, just to echo Dustin's thoughts, thank you everyone for spending some time with me this afternoon. Looking forward to it. Before I jump in, obviously today I do want to talk about the economy and the markets, but it's always good to take a step back and just think about those affected by the virus, their families, the brave healthcare workers, and the first responders, because without the work that the first responders and healthcare workers are doing, who knows how bad this virus will be. So it's always good just to keep them in our thoughts because, again, while we're talking about the economy and the markets, it's good to think about them. So, with that said, the theme to my presentation is that the markets, and when I say markets, we talk about stocks or investors and so on. The markets want 2 things from policymakers. Number one, what's being done to stop the spread of the virus. And we've seen some great news in terms of the virus, plateauing, the number of cases are declining. That's really good news. But also, people want to know from policymakers what's being done to stop the economic disruption. These 2 don't go hand in hand. Social distancing is definitely working. We're seeing it already, but the economic costs are mounting dramatically. So with this in mind, kind of as a backdrop, our 3 predictions for the rest of this year, and I'll dive into each one of them, but our 3 predictions are: number 1, we expect a U-shaped economic recovery, and I'll talk about what that is in a second. Number 2, we will continue to see significant market volatility. Yesterday was a great example. In the last hour trading, stocks fell about 1% pretty quickly. So we expect to see a lot of market volatility on a go-forward basis, but not see those lows that we saw back on March 23rd. And our 3rd prediction is that we expect to see, coming out of the recession, some type of new market leadership, new kind of a rotation in the market, really being driven by an increasing market breadth. So those are our 3 predictions. And they represent our base case scenario. Of course, they're subject to change. We could have a trade war escalation. We could have a second virus wave in the fall. The vaccine could be found very quickly. But again, these 3 predictions represent our base case scenario. So before I kind of dive in, I always think it's a good idea just to kind of take a step back and say, how did we get here? And there's so many reasons why we've seen, why I'm working from home, why Dustin is working at his home. There's so many reasons that driven this. But in our perspective, there's 3 things that drove how we got here. Number 1 is just the economic concerns from this virus. Think about this. This virus is very, very rare. It's both a supply shock and a demand shock at the same exact time. And when I say a shock, I kind of mean like an economic disruption. And it's a rarity to have both a supply and demand shock at the same time. Think about the Great Recession. In the Great Recession, we saw a demand shock. Unemployment jumped dramatically. People stopped spending money. That was a demand issue. But this is both a supply and demand issue. From a supply standpoint, we're not traveling, we're not going to restaurants, businesses are closing, factories are closing. All of these are impacting the supply side of the economy. At the same time, we're not going to restaurants, we're not going to malls, we're not going to sporting events, and this is really impacting the demand side at the same exact time. So that's the first issue. Number one, the economic concerns. The second issue kind of driving this market volatility is the price war between Saudi Arabia and Russia. So earlier this year, Saudi Arabia was pushing for higher oil prices, and there's many reasons why. They have a significant fiscal responsibility for their people. Russia, on the other hand, wants much lower oil prices, and there's many reasons, but the key thing is that they see the growing threat of U.S. shale producers. So they want oil to be below that break-even level, that $45 per barrel level, to kind of put U.S. shale producers out of business. So you have these two countries fighting over the direction of oil, and at the end of the day, like a kid in a basketball game, they said, forget this, and they both just said, we're going to do it our own way, and they both flooded the market with oil. That's why oil sold off dramatically. A lot of times you may think, well, isn't that good news because oil prices are lower, gas prices are lower? That's usually good news to the consumer. But the problem is that the oil industry, the energy industry in the United States has gotten so big. Today, it represents about 8% of U.S. GDP. So there's just really some concerns about the effect on the economy. So you've got the economic concerns, you have the oil price war issue, and the third thing that kind of drove this market uncertainty, this volatility, was just really disappointment out of Washington. In Washington, and this is both to the Fed, the Federal Reserve, and in Washington in politics. So with the Federal Reserve, we know the Fed, and we talked about this when I presented to you last time. The Federal Reserve is in charge of interest rate policy. They do a lot of other things, which I'll talk about later. But the really big thing they do is interest rate policy. They cut interest rates. So when they cut interest rates, credit card rates go lower, mortgage rates go lower, auto loans go lower, and this basically pushes borrowing costs lower, and this stimulates the economy. If the economy is going too fast, they raise interest rates, borrowing costs go higher, and it slows the economy down. What worried the markets was back earlier this year when the virus was spreading throughout the world, when the economies were slowing down outside the world, the Fed came out and said, we're not going to lower rates. We are in a wait-and-see approach. We are in a very, very data-focused approach. And the markets freaked out. They're like, you see what's going on in the rest of this world? No way. So the markets freaked out because of that. Washington, similarly. So first of all, you had, Republicans fighting Democrats in Congress, but you also had disappointment out of Washington, out of the White House. And I'm not a Republican, I'm not a Democrat, so I'm an independent. But there was disappointment from President Trump. I think on March 15th, he came out and said the virus, it's like the flu. It's not that big of a deal. So clearly there was disappointment coming out of Washington. So you take these factors together, and markets were really disappointed. And you think about us, we as market strategists, we tend to look at market valuations. Is the stock market cheap? Is it expensive? And one common way we look at valuation is simply taking what we call the price to earnings ratio. So the price to earnings ratio, it's a price of the index, so let's just say the S&P 500, divided by the earnings of the companies in the S&P 500. This is your classic PE, or price to earnings ratio. And because of this uncertainty about the economy, about the oil price war, about what was going on in Washington, investors had no perspective on where earnings were going to go. They had no idea where would earnings be at 1 month, 2 months, 3 months later. So they couldn't do anything with the E. All they could do was really focus on the price. They started pushing the price down. The PE ratio came down and down. So again, this is why we saw so much pressure, so much of this volatility in the stock market earlier this year. Again, investors trying to push stock valuations lower. So that's where we are today. So with that said, going forward, what are our 3 predictions? So again, number one, and I'll spend some time on this. Number one is we expect a U-shaped economic recovery. So a U-shaped economic recovery is when the economy falls, as it has, but then slowly improves. Pretty straightforward. So again, a U-shape in the economy. And why is this the case? As I mentioned before, social distancing is definitely working. It's reducing the spread of the virus, but at the cost of economic data. And the question we always get is, are we in a recession? Well, the government needs to officially define a recession as 2 quarters of negative GDP. All this really means is just that it's 2 quarters where the economy goes negative 2 quarters in a row. That's when you have an official recession. We are not in an official recession yet, but we are in an unofficial recession. Based on the data, we are in a recession today. Let me give you an example. You look at first quarter GDP. So this is the economic output of the United States in the first quarter, and this fell 4.8%. But the worst part about that number was that, think about the first quarter, the economy was only shut down for 2 weeks, just the last 2 weeks of March. That was it. And so this shows the severity of the economic disaster caused by the virus. By being shut down by 2 weeks, we saw economic growth go negative. Where will GDP go? For the second quarter, we do estimate that GDP could fall anywhere from 30 to 40%. If you look at there's a data point called the Atlanta Fed GDP Now. It's what the Fed puts out. They're estimating GDP in the second quarter to be down negative 42.8. So again, a lot of bad data coming. But the good news is that, in our opinion, related to this data, is that we believe that the data, the bad data, the economic pain is really front-end loaded. And our key theme around the economy is this, is that March's data was bad, as I mentioned before. April's data will be worse, but most importantly, it sort of represents the low point or close to the low point in terms of economic data. So let me kind of talk about some examples about this. So again, the key theme is March's data was bad. April's data is going to be a lot worse, but the good news is that we think we are close to the bottom in terms of economic data weakness. So some examples. So obviously, first of all, you got to talk about the jobs picture, the jobs, and look at jobless claims. So over the last 8 weeks, we've seen 36 million people lose their jobs. It's an ugly, ugly number. And to put this in perspective, the expansion, the longest expansion in U.S. history, which just ended back in the first quarter, we saw 22 million people get jobs in 10 years. We saw 22 million jobs get created in a 10-year period. In the last 8 weeks, we saw 36 million jobs get lost. Think about that. Just to put that in perspective, that's about 10% of the U.S. population. Unbelievable. We saw a payroll report, and this is a monthly look at the employment status of Americans. And we saw the payroll report show that 20 million jobs were lost during the month of April. 20 million jobs. And the unemployment rate jumped to 14.7%, highest since the 1940s. The worst part of that data is that employment report is mid-month to mid-month. So it goes from mid-March to mid-April. So it doesn't even reflect the last couple of weeks of April. So again, we think the jobs data will get a little bit worse before it gets better. The good news that we're seeing from the jobs data, again, the bad jobs data, is that about 80% of those unemployed are considered furloughed. So when you go in and you fill out your unemployment claim, there's some questions around, do you think your job loss is long-term or temporary? 80% of people think that the job loss is temporary. This is good news in our opinion, because this suggests that they think the job losses will be short, which we also believe. And you can also see this in terms of consumer confidence. So if you look at consumer confidence today relative to where it was in past recessions, it is nowhere near the levels, nowhere near as bad as we've seen in prior recessions. So all we're saying is, yes, we've seen a lot of jobs lost, but the majority, potentially 80% of them, could be temporary job losses. Another area in terms of data is manufacturing. So when I presented to you last, I spent a lot of time talking about my favorite indicator. It's called PMI. PMI, again, it's an acronym for Purchasing Managers Index. And just as a reminder, it's a survey of hundreds of purchasing managers all across the country. And they're asked very simple questions. How's business? Is it getting better? Is it getting worse? How are new orders? How are inventories? How are supplies? A bunch of questions that they're pulled in together. And whenever this index goes above 50, it's considered expansionary. Below 50, it's considered contractionary. So 50 is that magic, is that important number. When we saw PMI come out for the month of March, it was 49.1. It was below that 50. April's was 41.5. But we're starting to see indications that the data is starting to bottom out ever so slowly. For example, if you look at the last report, new orders, production, and the employment components of this overall number were all down in the high 20s. Ugly, terrible number. But if you look at past recessions, the high 20s seems to be the low point that we've seen in terms of these PMI data points. So all I'm saying is that the data looks like it's starting to bottom out. One more data point is the Empire State Manufacturing Survey. So this is a small survey. It's from New York, and it really goes over how is manufacturing in the state of New York. It's a very small report, but it's the first look at the prior month's economy. And this report fell. For this report, below zero is bad, above zero is good. This report in the month of April dropped to negative 78.2. So negative 78.2, unprecedented. This is a terrible, awful, ugly report, negative 78.2. What we saw for May, again, this is the first look at May's economy, first really official look at May's economy. This rebounded to negative 48.5, negative 78.2 up to negative 48.5. The market expected negative 63.5. So it all sounds ugly, but again, all it's showing that the data is starting to get better slowly but surely. And if you also look at the new orders within that index, they've all bounced back. One more, and I lied, one more data point that I want to talk about. TSA check-ins, okay, people checking into airports. Think about this. A few days ago, about 2.4 million people were checked into U.S. airports by the TSA. 2.4 million. This past Sunday, 253,000 people were checked in. So we went from 2.4 million to 253,000 people in just 1 year, a decline of around 90%. But that 253,000 that we just had on Sunday was the highest number of people checked into airports since March 24th. So again, you see the data is getting slowly better. And if you think about the low point in terms of check-ins, back on April 12th, about 95,000 people were checked in. So all we're saying is the data is bad, but it's starting to bottom out ever so slightly. A lot of people out there, so again, our thesis is a U-shaped economic recovery. A lot of people out there will say, well, we expect a V-shaped recovery or we expect an L-shaped recovery. We don't see either. So a V-shaped recovery is when the economy falls and bounces back really fast. We don't see that. I mean, the economic hit was so big. I went over some of this data earlier. There's a lot of caution about coming back. We talk about social distancing and how will restaurants look, how will bars look, how will stores look, lots of caution. And there's also lots of unknowns about the virus. We truly believe a V-shape is not in the cards. An L-shape, another common description of a recovery, is the economy falls and it continues to decline. And you could think of like a depression. And we don't see this either, because the important point of why we don't see this is that the monetary and fiscal stimulus is so strong. It's huge. It represents about $7 to $8 trillion. It's over a third of the U.S. economy. So as a kind of a side note, when I talk about monetary policy, really I'm talking about the Fed. And the Fed does a lot with monetary policy, but really the Fed, as I mentioned earlier, they come in, they cut interest rates. When they cut interest rates, borrowing costs go lower, it stimulates the economy. Fiscal policy is basically the U.S. government coming out and spending money, either cutting taxes, infrastructure spending, basically reducing infrastructure and reducing bureaucracy, basically things to spend money to really improve the economy. So let me talk about both of these, because these are so important in terms of our U-shaped recovery. Again, the economy falls, but slowly recovers. So let's talk about monetary policy first. And the Fed has really stepped up, and the Federal Reserve has really, really stepped up. Number one, first thing they did, and I know Dustin has talked to you about this before, first thing they did is that they lowered interest rates. They surprised the markets and they cut interest rates by 1.5%. Unexpected. So they cut rates by 1.5%, borrowing costs drop almost immediately. That's really, really good news. And we love that the Fed did that. It was important. The second thing, and the most important thing that I believe that the Fed did, is that they improved market confidence by improving bond market liquidity. This is important, but let me say it again. What they did is that they improved market confidence by really driving bond market liquidity. And that's kind of a mouthful. So let me give you kind of an example of what I mean by this. And I'm going to apologize in advance because I'm going to really dive into the weeds here in terms of what the Fed did. But it is so important for you to see what they did and the ramifications in terms of the rest of the economy and in terms of the bond market. So again, just to say it one more time, what they did is that they improved bond market liquidity to drive market confidence. So there's an investment out there that companies use. It's a borrowing tool. It's called commercial paper. And commercial paper is basically it's a way that companies can borrow money for short-term cash needs. And the beauty of commercial paper is that you borrow money based on you don't need any type of collateral. You don't need to put up a factory or a building or whatever. You borrow money in the commercial paper market by basically using the strength of your name. So these large U.S. companies do this, like Procter & Gamble, like Dell Computer, like Amazon. They go in and they borrow money in the commercial paper market. They, of course, can have a lot of cash on their balance sheet, but there's lots of financial ratios and stability numbers where if you have a lot of cash on your balance sheet, it reduces your profitability. So what you want to do is have as least amount of cash as possible, because if you have all that cash, you can't use it for other projects. So what these companies do is that they go to the commercial paper market and they borrow for short-term cash needs, usually less than 30 days, for like a short-term expense, like salaries or like wages or something like that. And they go to the commercial paper market and they borrow it very cheaply on the strength of their name. But what happened is that as the virus was starting to hit the United States, commercial paper lenders were saying, oh, wait, hold on for a second. The economy is going to be impacted by this virus. We're already seeing the data. People are being laid off. Things are looking bad. We are so worried about this virus and the effect of the economy. We're going to start to raise commercial paper lending costs. All of a sudden, these borrowing costs started to increase. And these companies who are so used to borrowing this money very cheaply for short, quick needs and to pay for salaries or wages, all of a sudden said, oh my God, these borrowing costs were too expensive. So what they all did is they said, okay, you know what, instead of going to the commercial paper market, we're going to go to our banks and tap into our emergency credit lines. So for example, Boeing went in and borrowed $13.8 billion from its credit line. It fully maxed it out. GM borrowed $16 billion, fully maxed out its credit line. There's a stat out there. It's on commercial and industrial loans. From the beginning of March till mid-April, this jumped by $553 billion. Sounds good, right? But usually it is. That means banks are lending money. That means the economy is growing. These are all companies tapping into their emergency credit lines because they couldn't borrow money elsewhere. So you start to see things were seizing up a little bit. And this stress started to spread to the rest of the bond market. You saw high yield bonds. So a high yield bond is kind of a little bit more of an aggressive type of investment, but you do get higher compensation, higher yield. And high yield bond borrowing costs went up by 10%. So think about this. On a Monday, you're a high yield company. You go in and you can borrow money at 6%. On Tuesday, it's going to cost you 16%. Or investment grade, these higher quality companies. On a Monday, you could borrow money at, say, 4%. Tuesday, it's costing you 8%. So again, you can see how borrowing costs jumped dramatically. And basically, these companies it was too expensive for them to borrow money. So what the Fed did, and this is what I think is so important, the Fed went in and they announced we're buying $700 billion of treasuries and mortgage-backed securities. Awesome. $700 billion of treasuries and mortgage-backed securities. What this meant is that they went to these lenders, they went to these banks, and they said, we're buying that treasury, that mortgage-backed security, that treasury, all these securities off of their balance sheets. When you do this, you take these securities off of their balance sheets and you push cash to these lenders. Think about supply and demand. You're a lender. All of a sudden, you've got all this cash on your balance sheet, supply and demand. You start lending it out. You start lowering interest rates. You start pushing money out because you can't have all that cash on your balance sheet if you're a lender. This worked so well. This worked amazingly well. This worked out so well that the Fed said, you know what? Forget $700 billion. Let's make this infinite. So on March 23rd, they announced this infinite program of buying treasuries and mortgage-backed securities. This has clearly worked. Borrowing costs have dropped dramatically. Markets have reopened. Let me give you an example. Anecdotal evidence, but it's an important example. There was a 4 or 5 week period where a high yield company could not get any money. They couldn't borrow money. The market had seized up so much that after the Fed did this purchase of treasuries and mortgage-backed securities, they reopened the market. Yum Brands, or a high yield company, they own Taco Bell, Pizza Hut, KFC, and this is not a recommendation on this company, but they own Taco Bell, Pizza Hut, and Kentucky Fried Chicken. And they went to the market and they said, we need to borrow $500 million. And the market said, no way, we're not going to let you borrow $500 million. We're going to let you borrow $600 million. You can see how the market opened up because, again, the Fed went in and reduced the stress in the bond market. So I think this is the biggest thing that the Fed did. Switching to the fiscal side, switching to the government side, clearly there's been a huge dramatic shift in terms of the government. First of all, again, I'm not a Republican or Democrat, but President Trump declares the virus a national emergency. Good news in terms of financing. Also, Congress became very bipartisan. Think about this. Back on March 6th, Congress passed a fiscal stimulus program, and this program was $8.3 billion. Billion with a B, $8.3 billion. But if you go back to the first week of March, Congress was fighting, Republicans and Democrats were fighting over, should this be $7 billion, $8 billion, $9 billion? How much should it be? They're fighting over $1 billion. Turn the clock ahead to March 23rd. They came out, which is also the low for the stock market this year. March 23rd, Congress came out and they passed a $2.2 trillion program, $2.2 trillion. So you can clearly see there's a lot of bipartisanship growing in terms of Congress and fiscal spending. There's some talks about another fiscal stimulus program in the works right now. We do believe it will get passed, at least in some form. This fiscal stimulus is going to be most likely contain state and local aid, more aid for hard-hit industries, also more like payroll tax cuts and things like that. And there's some concerns that it may not get passed. Trust me, it will get passed in our opinion in some form. This is an election year. So can you imagine a House rep or a senator going back to their constituents in an election year saying, hey, that stimulus program, sorry, I didn't vote for it. That's not going to happen. It will get passed in some form, which would be great for the economy. So again, that's the first prediction. Again, a U-shaped recovery. The economy goes down and slowly moves up because of the stimulus applied to the economy. The second prediction we have for the rest of this year is markets are going to be volatile. Markets are going to be moving up and down. You're going to see sharp moves in the market. But the good news is that we don't see hitting new lows. We don't see going back to that March 23rd lows. So think about the markets. Okay, we've had a good performance in the markets lately. It's basically because investors are looking forward. They're ignoring the bad economic data today, and they're looking forward to the economy reopening, this month and next month. So there's really optimism around the reopening. We expect a lot of market volatility because there's got lots of positive news in the market. There's also lots of negative news, and we do believe that these two are going to collide with each other, creating market volatility. So let's talk about the positives. The good news: cases have definitely plateaued. We see this everywhere. State by state, you're seeing cases have definitely come down compared to where they were before. This is helping to drive the gradual lifting of containment measures. This suggests that activity will start to now improve, recover ever so slightly. The important point is that if you looked at analyses maybe 2 months ago or so, most likely the analyses pointed to the fact that the economy would start to reopen in June. We actually reopened a month earlier. And the good news is that a lot of the economic data estimates for the second quarter had priced in a June reopen and not a May reopen. So this is a positive surprise. And as we all know, the markets like to move higher on a positive surprise. They love positive surprises. So again, the fact that the economy is opening 1 month earlier, that a lot of the second quarter economic data does not reflect this, is a positive in our perspective. Second reason is just so much stimulus applied to the market. I talked about this before. You're probably sick of me talking about stimulus. And the third reason is that, as I mentioned before, is that we're sort of past that low point in terms of data, in our opinion. The data is still bad. Economic data is bad, but it's starting to plateau. It's starting to slow down in terms of how bad the data is. So that's the positive side. On the negative side, things that you got to watch, things we want to take with a grain of salt in terms of the markets, is that there's a lot of risks out there. You know, three things that we focus on that we're watching carefully. Number one, earnings, okay? So as we know about the stock market, if the economy is doing well, companies sell more widgets, they sell more units. If they sell more widgets and units, they make more profits. They make more profits, people buy shares of the stock. So generally, a strong economy drives earnings, and earnings drive stock prices. And I made some assumptions, so I do apologize, but basically earnings drive stock prices. Coming into this year, the market's priced in earnings would rise about 9% versus last year. Good year, right? Today, based on estimates, based on analysis, it looks like earnings are going to fall about 19.7% versus last year. So you can see how earnings are being ratcheted down. In the second quarter, the quarter we're in right now, the markets have priced in earnings could fall about 37%. So again, we do believe weaker earnings are going to impact stocks eventually. This will be in the back of investors' minds. Plus, you think about this, there's really little clarity in terms of where earnings are going to be. You know, right now, 40% of the S&P 500 companies, 40% have actually withdrawn their earnings guidance because they're not sure what's going to go on. Are people going back to restaurants? Are we going to go back to that store? Are we going back to retailers? So again, earnings will offer some lack of clarity. The second thing that kind of causes us kind of like a little bit of a pause, again, the negative points about the market, is valuations. So remember I talked about PE ratios, price divided by earnings? So valuations, this PE ratio has gone higher and higher. Think about this. In the month of April, the S&P 500 rallied almost 13%. So the PE went up 13%, but the denominator, earnings, actually went down 11%. So you see the P going higher or E going lower. Basically, the law of numbers, it's moving higher and higher. Today, on forward earnings, the PE ratio for the S&P 500 is over 21. Over 21. The 5-year average is 16.7. The 10-year average is 15. Yes, you know, there's some reasons behind having a higher PE because we have very low inflation, we have very low interest rates, but valuations are very high. They're pricing in absolute perfection. Second concern that we have in the market. The third concern we have in the market is oil, okay, the oil market. As I mentioned before, oil and energy represent about 8% of U.S. GDP, so 8% of our economic output. It also represents, energy companies also represent about 10% of the corporate bond market. So as we see oil still being below that $45 level, this is why 45 is such an important point. It's that break even between an oil company making a profit and not making a profit, especially for the drillers. You'll see we may see more layoffs, we may see more bankruptcies. All of this could impact the bond market. You know, a lot of people are going to say to you, well, the good news is that, you know, Russia and Saudi Arabia and the U.S. have cut oil supplies. That's true, they have. They've been cutting oil supplies. But if you take the supply cuts and you pull that through the end of the year, that represents about a 15% decline in supplies. Sounds good, right? Unfortunately, if you look at our gas levels, how much gas we're using, because we're not driving as much, you know, we're not flying as much. You pull that data today through the end of the year, that demand is actually down 30%. So supplies are down 15, demand's down 30%. There's a supply-demand imbalance right now. But the good news with that said, you know, a little positive to this is the fact that OPEC has a meeting in a couple weeks, so most likely they'll cut supplies. Saudi Arabia surprised the market and cut oil supplies recently, and there's some data out there suggesting that a lot of the U.S. oil drillers have already started to cut supplies. So again, there's some good news there. But at the end of the day, you know, we're watching what causes us some concern: earnings, valuations, and the oil market. So if you take these positives and negatives and you mesh them together, these headwinds and tailwinds, all this leads us to expect is that market volatility is going to pick up. We expect market volatility to move around. We expect big swings in the market. We do believe it's possible that stocks could pull back 10 or 15%. I know it sounds kind of scary, but that's a correction. And a correction, a 10 or 15% decline in the market, is pretty normal. It happens about once every 12 months. We had a big correction, a bear market earlier this year. The last correction we had was back in December of 2018. So again, corrections are normal. A 10 to 15% pullback, a profit taking, these are pretty normal. But the most important point about that prediction is we don't see us hitting a new low. We don't see us going back to March 23rd lows. The third prediction we have in our final prediction is we expect new market leadership. So what that really means is that we do expect different types of companies to lead the market going forward. Think about this. Historically, recessions have had consequences, and they've led to a change in market leadership. This happens all the time. Best example, think about coming out of Y2K. After Y2K, remember technology stocks were very, very expensive, and basically during the early 2000s and mid 2000s, technology stocks were one of the worst performing sectors in the stock market. People hated technology stocks. Boom, 2008 recession happens, early 2009, going forward, technology stocks become the market leaders. Recessions change market leadership. They tend to have consequences and change market leadership. Similarly, we think the same thing is going to happen coming out of this recession. We do believe a rotation into sort of new companies, new sectors are going to lead the markets going forward. One of the biggest reasons why is that we do believe that market breadth will actually widen. Right now, we have a very narrowly focused market. And what I mean by that is that only a few companies in reality are driving this market. Here's some more data. I apologize, this is the last of the data, but if you look at the S&P 500, from the beginning of the year until the end of April, the S&P 500 fell 9.3%. 9.3%. The top 5 stocks in the S&P 500 over that same time period were actually positive 11%. Market down 9.3, they're up 11%. You look at the top 5 stocks in the S&P 500, they have an average PE ratio, going back to price to earnings ratio, of 36. Remember, higher is more expensive. The rest of the S&P 500, 18. So 36 versus 18. Those 5 stocks in the S&P 500, those 5 big stocks, represent 20% of the entire market cap, the entire index, 20%. But at the same time, they only take in 8% of the revenues. Complete difference. So because of this divergence, we do expect market breadth to widen. We do expect other types of companies to start to take the leadership on a go-forward basis. Who could take the leadership? And again, lots of speculation, but we think these sectors are going to do well on a go-forward basis. Number one, we still think technology will do well. There's so much technology needed, especially working from home, especially for innovation, especially for access to information, whether we go 4G, 5G, 6G, ease of mobility, time savings. There's so many reasons why we think technology will continue to do well. But other sectors who really lag should do well. Financials should do well. We believe financials are going to do well. They tend to do well as the economy recovers. They also do well in a steeper yield curve. They've also done well coming out of past recessions. We also think industrials, similarly. Industrials, as we start to build out infrastructure, as we start to supply chain shift around because of what's going on with our supply chain disruption, industrials should benefit. Also, industrials have tended to do well coming out of recessions. The fourth sector that we like, healthcare, okay? Think about healthcare. The first quarter, I mentioned this before, GDP was down 4.8%. So the economy went negative by 4.8%, or fell by 4.8%. Healthcare spending dropped over 18% in the first quarter. People weren't going to dentists, weren't going to doctors, weren't going to hospitals. So spending in healthcare dropped 18%. These are essentials, surgeries, going to the dentist. All these things are very much essentials. We do believe this will bounce back later this year, and we do believe healthcare is a great opportunity. So all we're saying is that there's going to be we believe some type of market shift where other parts of the market are going to do well. So quickly, in summary, 3 things. Number one, we expect a U-shaped recovery in the economy. The economy falls and slowly comes back. Number 2, market volatility, but not hitting those lows we saw back on March 23rd. And number 3, what we expect is widening market breadth. Other parts of the market start to take the leadership, not just technology, not just a very narrowly focused market. So what's this mean for you? 2 things. Number 1 is the good news is that be diversified. Have a diversified portfolio. A lot of times investors out there, my mom in particular, she's a market timer. She likes to market time, go all cash, all stocks, all cash, all stocks, based on the whims. And the markets are moving around so fast. Who would have thought that the Dow Jones Industrial Average would have rallied 900 points on Monday? Stocks move around fast, so market timing does not make sense. Diversification is so important. Having exposure to different parts of the market. And Presidio, and with Dustin, he and his team, they do an amazing job to make sure that you're allocated to different parts of the market, not putting all your eggs in one basket. So they are doing this for you. But again, diversification is number one. It's so important. Number two is to continue to be in contact with Dustin and his team. And thankfully, Presidio has you. They're watching your portfolios. They're communicating with you because you need to make sure that you're in constant contact with them. And their team is that they're constantly reviewing your portfolio, reviewing to make sure that you and your portfolios are consistent with the risk that you should be taking in the market. A lot of other advisors aren't doing this. A lot of other advisors have said, "Oh, well, the markets have rallied for 10 years. They're going to keep going higher," and they aren't focusing on risk. Dustin and his team, Presidio, and the entire team are really, really focusing on making sure that your portfolio is appropriate to the risk that you should be taking in this market. And given the uncertainties, given this volatility, given this, the virus, given this U-shaped potential economic recovery, it is so important for you today. So Dustin, I know I kind of spoke all over the place. I spoke constantly. I did not take one breath, but that's really it for my prepared comments.
Yeah, that's good. I can hear the applause from the crowd out there. So good job, Gene. Appreciate that. So yeah, I mean, I always enjoy listening to you speak, and we share a lot of the same beliefs. We had our own resident CFA, Luke Jacobson, is a new member of our team, come on with me a few weeks ago and kind of shared a lot of the sentiments that you did about the current market breadth and the need for new leadership. So that was interesting to hear you kind of make that case. We were actually saying that same exact thing over the last 2 weeks in a row. We've been kind of commenting like, it's not the S&P 500. This is called the S&P 5 or the S&P 6 or whatever it is.
Exactly.
And that, as we play this out over the next 10 years, we're going to have new leadership of, companies that we don't know who they are yet today, but, are going to challenge some of those. So I do have some of my own questions, and I'm going to just remind everybody out there, use that Q&A portal, write down if you have a question for Gene or myself. We'd be happy to answer those. And I'm also going to launch the first of our 2 polls. So the first question I'd like to ask everybody is, based on the this on reopening and on the COVID, would you take a vaccine for COVID-19 if it were FDA approved? And so I'll give this about a minute. Go ahead and make your vote. All right. So as those are coming in, so, we at Presidio, Gene, and you probably know this, is we always talk about the big 3, right? These are the 3 things that want to make our clients' money worth 40% less than they will if we don't have the right strategy with them, and that's inflation, taxes, and market crashes. And so those are always the 3 things as wealth managers we're trying to navigate through, and it's quite a balancing act, right? So on the market crash sentiment, which is, I think, usually what's top of our mind and what always gets reported on, and what we're following the news. So you kind of talked about a U-shaped recovery, but then market volatility. Now, both of those things have been kind of in line with what we've been suggesting as well. So that's good. So actually, all 3 of your predictions were kind of in line with us. So that's nice. So I don't have any curveballs for you, which I was hoping to. I guess my first question is, who do you think you are? No, I'm just kidding. So on the market crashes, though, a coming second wave is kind of what we see as risk number 1. What are how do you think that's priced into the current market? And what do you think the expected downside case can be if we do have a second wave? And kind of what do you and your team talk about and watching? Because to us, we've seen that that's a likely event. And so far, the only thing that we have seen to really kind of contain the spread is to shelter in place and stay at home orders, which has been detrimental for the economy. And again, I've said it each week, I can't even let my brain go there thinking of me sheltering in place from October to April or May of, this next season. So how do you guys reconcile that in your decisions about investing in the market?
Sure. Great question. So the question really, is there a second wave coming? And obviously we're not virologists, but we think there's a good chance of a second wave coming. This is part of the reasons why we're not like saying a V-shaped recovery. This is why we're a little cautious about the market. This is why we say stocks could pull back. The things we're looking carefully in terms of, will there be a second wave? Number one, we're watching Brazil. Brazil is, it's a fairly industrialized nation. I know the healthcare system is not as strong as we are. They have 18,000 ventilators, but I heard that aren't using them correctly. Some issues there. So the thing that worries us, because Brazil is a very large country and they're approaching their fall. So, they're getting more and more cases. So we're watching that as potential. Could that be a second wave? The other thing we're looking for is data in early June, because as the economy has started to reopen, based on virologists, you estimate about a 2 to 14-day period where the virus could reappear. So we're watching that in terms of, are these numbers picking up? So far, the good news, I'm seeing news flash. The good news is that it seems to be stabilizing, and we look at a lot of like rolling 7-day periods. So it seems to be stabilizing, but early June is going to be very, very, very important. How is this priced in? As I mentioned before, we're a little cautious. What this could lead to is almost what's called a W-shaped recovery. And economists and market strategists, they try to sound cool. They like to use these different letters to describe what they're thinking. A W is the economy falls, it goes up a little bit, falls again on a second wave and comes back. And that's the other scenario. We aren't pricing this in yet because we are hopeful of a vaccine, of course. But more importantly, though, we do think that that the stimulus, there's so much stimulus in the economy should potentially get us through this. But again, it's one of those factors out there that we're watching that could change our thesis. But right now, it's not our base case scenario.
Yeah, of course. And I mean, we always talk about, the fact that we don't have a crystal ball and no one really does. And so, we don't know, but I mean, that is information's in these three places. What we know, we know. What we know, we don't know. What we don't know, we don't know. And the market's going to kind of get that information. And that's, I think when we say there's lots of volatility, is saying there's a lot of information. We don't know which way it's going to go. So investors,
exactly.
As you kind of echo that sentiment, like understanding the risk tolerances, understanding the moves your portfolio can make, don't buy high and sell low, and don't be in a position to have to do that. I'm going to share the results from our first poll. So if I share the results here with everybody, looks like we have in the lead. Yes, I'll be the first in line to take the vaccine. I'd like to wait to see if there's any side effects. Was a close runner-up. I'm not sure. And then a few of us are saying no thanks to the vaccine. So that's our first poll there. I have a couple more questions for Gene. And I have another poll that I wanted to, let's see, stop sharing results. Let's go ahead to, oh, sorry. All right, there you are, Gene. All right, so I have some questions from the audience as well here. I'm gonna pull those up. But before I do, I wanted to ask you about what are your predictions on the election? So we have, it seems to me that we have a pretty tight race based on the current, betting sites as far as who's going to win the White House and how the Senate is going to go. It looks like we have the potential for a 50-50 tie, and then that makes, of course, the White House even that much more important as potentially serving as a tiebreaker. I think that the House is already thrown towards the Democratic side. So what would that mean for the stock market, right? Because I think that could probably have some implications for future volatility and potentially some downside there, depending on how it goes.
You're totally right. So if you look at betting sites, and we actually checked this morning, we check every week, not because we're bettors, but we just check sites. And
sure, Gene, sure.
President. So what did you say about the Patriots? I'm sorry. So President Trump is a slight favorite, very, very slight favorite in terms of the betting market. And the offshore markets are pretty good in terms of compiling all the data again. So we like to look at the offshore markets. President Trump is a slight favorite. The thing that always drives will the incumbent win the election is going back to that phrase again, it's the economy, stupid. And if the economy does well, the incumbent should win, so President Trump should win. Clearly, we're in a recession this year, so clearly that takes him out of the race. But the issue is that a recession caused by a non-controllable event could change the dynamics of everything. So all I'm saying is that it's a coin toss right now. It's a coin toss. Going into the 2016 election, we didn't think President Trump would win. We thought it'd be closer than the markets were predicting. And, obviously President Trump won. So, but we thought it was a little bit closer. What will happen in terms of president/Congress if we have a Republican president and a Democratic Congress? It's obviously that's good news for the markets because nothing gets done, and the markets like nothing to be done, and the markets don't like spending. If we have a Democratic president and Democratic Congress, that's probably the worst case scenario in terms of the markets. I'm keeping politics out of this. It's probably the worst case scenario for the markets. It's just about the business standpoint. Democrat president and Republican Congress, you may see an initial pullback in the markets because of the shock of having a less business-friendly president. But then the markets will realize, again, nothing will get done because if you have a split government. So those are the scenarios we laid out right now.
Yeah, absolutely. And I'm unaffiliated like yourself, but I do, look at, the information that the market has priced in, and we know the move that it made during the last election. And we know the move that it made when there's an announcement of the new tax policy. So there's been the decreased regulation, which the stock market likes. Right. There's been decreased corporate taxes, which translates, into some more earnings, which the stock market likes. And so if those things go away, that's, kind of doing the math, some pretty easy math on what could happen there. So, and our thought is just like, hey, here's another thing that the market is going to get data on and information on that's going to cause some volatility. And of course, volatility goes both directions, right? So we only care about one side of those directions of volatility, but things that we're watching. So those are kind of our two things that we're watching: the second wave, and then see how the election gears up and what potential volatility that's going to have on the market. On a longer term, and I don't know how long term we're talking, we have a big concern about inflation. And so, kind of seemingly, you talked about, the commercial paper, you talked about how much money is out there into the system, how much more stimulus is going to be passed. And, it seems like this is a perfect recipe for inflation, and that will probably go unchecked in our opinion for some time, which, is okay typically. But we have had a generation of people or two who really haven't had to deal with inflation before. And so it's not something that everybody remembers as something that's going to really impact their portfolio. And so, this is the balancing act between inflation, taxes, market crashes, is sometimes we do all the things to insulate us from the stock market. And here we are losing money to inflation, on just about the same basis that we could in the stock market. So, what are your thoughts on inflation in the coming, years ahead?
Great. That's a great question. And the common question we get a lot, it makes sense. Because if you think about this, the stimulus, you need to pay for it. We have to pay for it. And the beauty of the government right now, the government is basically saying, it's like, if using the analogy of you have a leaky roof. Your roof is leaking and it's raining outside. You're going to do whatever you can to fix that roof and worry about the cost down the road. And that's what the government is doing. We're basically looking to do whatever we can to get ourselves through this recession. When we have to pay for it, there's two ways we can pay for it. We can raise taxes, or we can issue more debt, more treasuries. And most likely, what we're seeing already is that the government's going to be issuing more treasuries. Even today, we saw the government issue 20-year bonds. We haven't seen 20-year bonds since 1986. Newly issued since 1986. So again, the government's coming out and issuing new bonds right now. The result of this is that you'll have more treasuries in the market, more bonds in the market. And you think about supply and demand. You have more bonds in the market, prices go down, yields move higher, so bond yields are going to move higher. Also, the dollar will become a little bit weaker in our belief. A weaker dollar causes inflation, as we all know. We saw this with, say for China last year. They weakened their currency because of the trade war. They started to import inflation. We do believe that inflation will increase because of the dollar and because of more treasuries. The thing that's going to hold inflation back, the question is, when will inflation come? We don't see inflation coming for a while, though, maybe another year or 2 years. And the rationale is, first of all, the economy has slowed down so much. So you've seen the slowdown in the economy. Second of all, oil prices, gas prices, commodities are down. The only commodity that's actually higher right now, I think pig roast, or pork roast, whole chickens, beef roast, and eggs are the big things moving higher. There's some food shortages, but those will be cleared out eventually. So we do believe that there's a lot of pressure to keep inflation lower. What we're watching, though, eventually is that the inflation coming from U.S. government, so this is late, maybe in a year or 2 years. Also, what we could see is wage inflation. That's something that we have, people don't really talk about. Think about the unemployment claims right now, unemployment insurance. Someone can collect, $4,200 really through unemployment for a month. And if you kind of look at, I know friends own their own restaurants, they're trying to hire people back in anticipation of reopening the economy. And they're paying, they were paying $15 an hour before. They said they can't get people to work because people are getting more money by not working. So you'll start to see wages start to move higher in order to hire more people. The big thing that we're worried about is what comes out of this is a potential stagflation environment. Stagflation is a very slow economy, a very slow economic growth, but rising costs. And the last time we saw this was basically in the late 70s. Remember the last time we had a supply and demand shock at the same time? This is a 73 to 75 recession. Basically, people stopped spending money because they were losing jobs. At the same time, OPEC came in and started to squeeze our supply of oil. Oil prices jumped up, supply issue, demand went down, people weren't spending money. This created this similar shock that we have now, and it's created inflation in the late 70s and early 80s. So again, we do see inflation coming, but again, there's because the economy is still fairly fragile and weak, we don't see inflation for at least a year for right now. Long answer to a short question, sorry.
Yeah, so it seems like it's kind of, we have to see how the recovery plays out to know how, what inflation is going to look like, or when it's going to come. But
exactly,
it's going to come, and it's something that
we do believe.
Yeah. Okay. And then so when that time comes and we see an inflation, where would portfolios be better positioned, overweighted or underweighted that could be affected by inflation?
Well, thankfully, you and your team are big believers in diversification. So you have exposure to different parts of the market. There's always like inflation-protected bonds. So that's one potential opportunity. The problem is that they do have a higher interest rate sensitivity, a higher duration. So there's some interest rate potential loss there. You also look at commodities. Commodities are a good example. Also REITs, some real estate exposure, because when costs are rising, you have the ability to raise rents. And that's a good positive inflation. But other than that, they're in commodities and gold. So that would be sort of the big areas we would look at.
Okay. Good. Yeah. And I mean, certainly it's going to be interesting to see the future of real estate as we come out of this. And,
Definitely.
we're thinking there's going to be some big changes there. So,
But Dustin, the good news about real estate, though, so think about commercial real estate. Commercial real estate, we're watching carefully because, look, I'm working from home. So we have the ability to will we need as much office space as we did before? Most likely not. On the other hand, residential, I live in Santa Monica. I do a 5-mile run every day. 6 months ago, I'd see maybe one for rent sign. This morning I saw about 30 for rent signs. So there's definitely more, there's less demand for units because people are moving away, people are moving outside cities. We're watching this carefully, but with that said, the good news is that we don't think we're in a housing bubble. I talked about this when I presented to your group back, earlier this year or last year. We don't think we're in a housing bubble. We do believe there's some pockets of strength, especially here in California and the East Coast. But the good news is that mortgage applications have risen the last 5 or 6 weeks, and building permits, housing permits to build new houses have actually been rising a little bit. So there's some good news out there in the market, in the economy. So.
Yeah, certainly. And I mean, the single family homes and multifamily, I mean, we need a place to live. And so there might be some migration, but there certainly continues to be more and more people. And that's going to be a challenge that we have to deal with as a society for the next, 50, 100 years. Who knows about the office buildings and retail, and they have some serious challenges there of who's going to fit in that new big box.
Sure.
Good. So appreciate that. Let's see. Also, my last question for you. Well, actually, you brought up the 20-year the 20-year Treasury, and I had a question here. Do you know how that did today?
I think it was actually came in more. I mean, the demand for it came in more positive than people anticipated. So it was good. It was a good demand. So I was surprised by that. That's part of the reason why bond yields are a little bit lower right now, because the demand was so good for these bonds. So I don't know if that's a good thing or a bad thing, because if there's so much demand for treasuries, this is people saying, well, I think treasury yields are going to be even lower, which is bad for the economy. But a positive would be yields here are still pretty high versus other countries. Because we also saw the UK issue negative rate, bonds today. So there's negative rates across the world, in some countries across the world, and some people view yields here in the US are pretty strong. I do worry about that, because if you're a foreign investor, hedging against the dollar, and I know we're getting into the weeds here, but hedging against the dollar is very expensive right now. And if yields move, say, 20 or 30 basis points, it eats up a lot of your returns already after hedging costs. So even by that hedging. So we're worried about this. Or even a 5% move in the dollar really reduces your return. So we're watching things like this carefully.
All right. I'm going to just see, I know I've been trying to check some of these boxes from some of the questions that we've had here from the audience. I want to make sure we can. Let's see. When do you think would be a good time to buy into the stock market?
Hindsight's 2020, right? It's hard.
Yeah.
I mean, we think, the biggest issue is, as you said, it depends on your risk level. Depends on your overall philosophy, like your risk level, and it's taking the appropriate risk. Even with the market selling off earlier this year, if I'm a long-term investor, I'm still going to be 100% invested in stocks, because long-term stocks do very well. So it depends on each investor. Yeah.
I think it's just, we're going to let the audience decide the answer to this question in our next poll.
Oh, okay, great.
So I'm going to go ahead and ask everybody, what do you guys think the stock market is going to be? Do you think the stock market will be higher than it is today 1 year from now? Yes or no? 3 years from now? Yes or no? Or 5 years from now? Yes or no? So we'll go ahead and put this one, poll the audience, right? Isn't that one of the options? Phone a friend, poll the audience. Get a lifeline in there. All right. So that's good. So I'll let those. Well, I don't know. You're getting some friends here. We have some Jimi Hendrix fans that are on here commenting. And then I think a lot of us want to know, is that a trophy or is that your Stormtrooper helmet? Are you on the dark side? Are you on the Jedi? Where do you fall in?
That's actually a gift from a friend. That was it's actually a, what do you call it? Like a piggy bank. So.
Oh, nice. That's pretty cool.
Yeah.
Yeah. We've been getting some comments.
I should hide this.
No, it was good. It was making me feel like I needed to get some cool stuff up there. So no, we had some good comments about that. So we have some Hendrix fans out there applauding your poster. So that's pretty cool.
Yeah, all on the watchtower.
Yeah, there you go. All right, so I'm going to go ahead and end the results here and share the results with the audience. So, if your question is, when do you think it's a good time to invest in the stock market? 65% of the audience today believes that it's going to be higher 1 year from now, or 35% believes it's going to be lower 1 year from now. So that's any indication. The high probability is 3 to 5 years from now. It's about 93% to 8% who think yes, it's going to be higher 3 years from now. 5 years from now, again, 95%. So, again, time is our friend when it comes to investing. And so anybody asking this question, when is a good time to buy? You always have to say, well, when do you plan to sell? And, we would certainly encourage that if anybody needed their money in the next year, that the stock market is not the best place for it. And that the longer time that you have, at least historically, the better odds you have at making money when you invest in riskier investments such as the stock market. So hopefully if you're thinking about timing, you're thinking about you have a long way to go, that's going to help a lot of your decision making, and certainly how we create financial plans. because again, it's just math. So that's how we answer these questions. Let's see. So Gene, I've taken you a little bit past 5. We'll see if there's one more question here. If bond treasuries aren't paying anything, that can be, what can be less risky investments? So I get, what are the alternatives to bonds and treasuries, cash for other investments? Yeah, it's cash.
Triple leverage cash. Okay.
Yeah, and so I mean, this is kind of why we are watching inflation, and where when you have really low interest rates, you have a lot of cash, you have a lot of money out in the system, you have potentially negative yields. I mean, these are things that are going to likely spell inflation. That money has to go be put somewhere, and it starts buying asset prices higher. And so that's why we are really going to be watching inflation in the coming years ahead as something that we, all the stars are aligning. And, people will say that, last time everybody forecasted inflation, in 2008, 2009, we did all this stimulus, we did all this monetary policy and got all the money out there. And everybody told me to be worried about raising interest rates and inflation. It never happened. And so, we know that this is a lot different, this type of stimulus, right? And this type of recession. And not everything not every recession is going to be the same. They're all very unique and different. We have some similarities and some things that we're going to do, some of our responses, which what we found have worked. Just remember, the last recession was a liquidity crisis, and the banks didn't have any money. They just didn't have any money, and the insurance companies didn't have any money. They had lent it all out. And so, when we did a lot of stimulus the last time, it just sat on the bank's balance sheet. But this time around, we're sending checks, to everybody's house. We're sending it directly to the businesses, small and mid-sized businesses, that is going directly to their employees. So this is very, very different stimulus and monetary policy than what you saw the last time around. So, there's a lot of money into the system. It's pretty unprecedented how much money is out there and how much cash is out there. So, that again is going to spell things that are going to lead to inflation. And I mean, historically, stocks, companies, have the ability to raise their prices and earn, are you going to pay more for your iPhone if you have a bunch of money in the bank and you have that, cash out there, seemingly historically, that's where we see the inflation. So, so I think that that's something that we're all watching. So good question out there. But it's a long road. Right. So we've time and time again, we've kind of reminded everybody out there to be patient, take that cool, cold blood like Warren Buffett has and be comfortable. These things take some time, and we are in a recessionary bear market, and we're only about 2.5 months in. And typically on average, the last, all of those on average since 1950 have taken 4.5 years. So, when we were looking at a U-shaped recovery, we're looking at the economy, we're looking at the stock market. It's a little bit different, and it's going to be a lot of green, a lot of red, a lot of volatility, like Gene was saying. So anyway, Gene, so glad that you can join us here today. It was a pleasure having you. We're going to bring you back, of course. And I gotta tip my hat to you. Your predictions the last time around when we had you at our event a year ago were kind of right on, right? So you did a good job. So we're very in tune to what you have to say coming into the fall season here. So always a pleasure. Everybody else, thank you for joining us. You can join us next week at 4 o'clock. Have a wonderful Memorial Day weekend. Thanks, guys. Bye-bye.
Thank you, everyone.